Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 12th of September 2024. So the key question is, are we going to see any follow through after yesterday's big recovery in the equity markets in the US? Well, a lot will depend on what happens as the major indices test key levels. Are we going to see any bullish momentum, or is that momentum going to fade like we've seen several times in the past few weeks? And judging by early price action, you can see that the S&P 500 has indeed failed to show too much follow through. After breaking yesterday's high, it's gone back down and is trading a little bit lower on the session so far. So something to keep an eye on as we progress towards the latter stages of the European session. And likewise, if you look at the other major indices, for example, the German DAX index here, it too has faded after starting the day on the positive front, and it's now lower on the session, tracking a weaker Chinese markets overnight. Going back to the S&P chart, and the key area to watch is this shaded region right here between 5,564 to around 5,580, which was previously resistance and support before the index broke down on Tuesday, 3rd of this month. It's now retesting that area from underneath, so it could provide resistance. In terms of support levels to watch, 5,500 to 5,480 is a key short-term area. And if we were to break below that, then that could put the bulls in a spot of bother, especially if we go on to take out yesterday's low at some point, either later today or later on in the week. If that were to happen, then we could see the onset of a sharper correction in the equity space, because I think at the moment we don't have too much bullish catalysts to keep the markets supported near all-time highs. So I think there is a risk of a correction, but so far we haven't seen that confirmation that the market has stopped. Indeed, it could just easily turn around and push higher, so it's very important to watch what happens around the shaded area. If it goes on to reverse later on and break through this area, then that could be a sign that the market will want to push higher and test the recent highs that were hit in July. Right now, the most important currency pair to watch is the dollar yen. The dollar yen has been causing all sorts of volatility in the equity space because of the unwinding of carry trades as the Japanese yen has strengthened. After its sharp drop, in the dollar yen pair in August, we saw a bit of a pullback, but it didn't really retrace too much, and resistance held at around the broken trend line that goes back all the way to 2023 January of that year. The backside of that trend line held as resistance, leading to fresh selling that gathered pace last week. This week we saw a drop towards 140. Didn't quite get there yesterday. It bounced back quite nicely, and that helped to trigger a short squeeze rally on the indices as well, I think. But now you can see that the momentum has faded once again, and we're back below yesterday's high, and now testing this area of uncertainty at around 141.70 to 142.20. I think if we go below this area today, that would be bearish, and in that case I would expect the dollar yen to continue lower towards 140, supported by a hawkish Bank of Japan and a dovish leaning Fed now, who are seen cutting interest rates by 25 basis points at the next week's FOMC meeting. With the Fed turning dovish, we have seen gold break to a new record high today. It was coming, wasn't it, really? The consolidation near August high around this shaded area, which I had highlighted previously, looked like it wanted to push further higher because of the lack of any real selling pressure. And lo and behold, today we have broken out after spending several days, weeks even, in consolidation below that low, below that August high. So the key question is, where do we go from here? Well, I think the path of least resistance is clearly to the upside, and for as long as we don't create a false breakout scenario, I think the bulls will be happy to step in on the dips and continue to push the metal higher. The key level to watch is this level here at 2,473, the most recent low. Should we break below that, I think at that point I'll have to drop my bullish bias on this market But we'll cross that bridge if and when we get there. For now, I wouldn't be surprised, for example, if it goes to 2,600 or even higher in the days ahead. Keep an eye on bond yields as yields weaken. This tends to boost the appetite for gold, which is a non-interest bearing commodity. For more market insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.